Welcome back to the final dashboard of Project Pulse. In the last few lessons, we have completed the full cash flow engine for the project. All revenue streams, operating expenditures, and both the initial capex and the augmentation capex, with the major maintenance reserve account saving up for those future augmentation events. You can see the effect of all of that in the cash flow waterfall. That means that we now have everything we need to determine the unlevered project cash flow, which means we are ready to calculate the unlevered pre-tax project IRR. Unlevered meaning no financing yet, and pre-tax because we haven't modeled taxes so far. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. The internal rate of return, or IRR, is simply the discount rate that makes the net present value of all project cash flows equal to 0. Intuitively, it's the annualized return the project generates on the investor capital, given the timing of the upfront capex and all future cash inflows and outflows. In practice, we don't solve this by hand. We feed the dated cash flows into Excel and use the XIRR function to find the rate that drives NPV to 0. If the IRR is higher than the required return, the investment creates value. If it's below that hurdle, it destroys value and should be repriced or rejected. The unlevered project IRR is the clean benchmark figure for asset returns. We look at it before financing and taxes, and then see how debt and tax effects move the equity IRR up or down. Now let's go back to our checkpoint file from the previous lesson. We now have everything we need to compute the unlevered pre-tax project IRR. Let's recap some terminology. OPEX are the day-to-day operating costs that hit the income statement in the same period they're incurred. CapEx, on the other hand, are long-term investments into the asset. They sit on the balance sheet and are depreciated over time, something we will implement in detail in the next lesson. And EBITDA is earnings before interest, tax, depreciation, and amortization. In this model, it's effectively our operating cash flow, before CapEx, MMRA movements, and financing. Alright, let's start by pulling in these line items. We'll start with our total initial CapEx, excluding financing fees. Why excluding financing fees? Because this is our pre-tax unlevered project IRR. Unlevered meaning before any financing. So let's scroll up. And you can see this line item in 350, total CapEx excluding financing fees. Now watch out, here this value is positive, and for our IRR calculation we want to make sure this is a negative value. So let's pick up minus 350, hit enter. Then the second line item for our uses of funds is going to be our MMRA contribution, which we have modeled in the last lesson. And again here, this is modeled in 385. Those are our contributions. And we will have to flip the sign again. So that's minus 385. Hit enter. And some of you might wonder now, why do we pick up the contributions and not the release? And that is because the project has to save up cash in a dedicated MMRA cash account to then be able to do the release once the augmentation event actually occurs, which is why the cash movement itself is our MMRA contributions and not the release. So that gives us the sum of all uses of funds, or CapEx. So we can drag this over, Control R. And you see we spent in case 15 initially $114.5 million to build the initial project, and then $22.8 million for 2 augmentation events. Then we can pull in our total revenue. That equals, let's scroll up, row 260, where we have modeled our total revenue. That is a positive figure, meaning it's a cash inflow, so we don't have to flip the sign here. And then let's pull in our OPEX. And since this here is positive, we have to flip the sign again. So that's minus row 308. Hit enter. And EBITDA, or our operating cash flow, is simply the sum of those two. So total revenue minus OPEX. Drag this one over, Control R. And once we have EBITDA and total CapEx, we can simply add those two figures, which will then give us our pre-tax free cash flow. So this equals our total CapEx line plus EBITDA, or our operating cash flow, and drag this one over, Control R. And in very simple terms, in case 15, which isn't the most profitable case, what will happen is that we spend $137 million, and over the asset life, we get out an EBITDA, or operating cash flow, of $229 million, and that is before paying any taxes, which leaves us with a net positive cash flow of $92.5 million. And that then allows us to compute our unlevered pre-tax project IRR, so type X IRR. Then we select the values. Make sure you pick up the negative value right here, otherwise the X IRR function won't work. Select all of these values here, and then we will say comma. And now it's important that for the dates, we pick up our end of period. So make sure that you pick up the same width from column K6 to AT6. Hit F4 once, close parentheses, and hit enter. And we get an unlevered pre-tax project IRR of 6.02% for this case. And this is a relatively low unlevered pre-tax project IRR. But as you will see, as we go through the case study, we'll have many different asset structuring approaches, some of them resulting in much higher unlevered pre-tax project IRRs. So this number is essentially the core profitability of the asset before financing and taxes. And in the next chapters, we will see how adding financing can boost the equity IRR, as long as the cost of debt is below this project IRR. And how taxes will then pull the return down to an after-tax level that investors ultimately care about. Alright guys, this was it for this lesson, and I will see you in the next lesson. See you there.